Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Wanted to do a quick video talking about consumer price index. So that is CPI for the US. And so just to sum up, we had CPI inflation. We have both numbers, the core number and the headline number come in stronger. So when we look at inflation numbers, we look at two numbers. One is the headline number month over month. One is the core number, which is month over month also that we look at. We do look at the year over year components and the other components as well, just to get a bigger, broader idea of what's happening. But what the difference is between the core and the headline is that the headline accounts for fuel and energy cost. Now, the fuel and energy cost tends to be a little bit more volatile, right? Because you get energy prices, gasoline, crude oil moving up and down. It can really fluctuate numbers quite a bit. Now, the core number is the number you want to focus on a little bit more because it takes out that volatility, it takes out that energy prices. So I'm going to share here my screen and show you real quick the numbers so you have an idea what I'm talking about. Okay. So here it is. We have the core CPI month over month coming at 0.6 versus the expected of 0.5, so higher than expected. We had the headline number, which is right here, coming in at 0.4, way higher than the expected of 0.2. So again, higher, both higher than expected, which was basically negative for the equity and the bond market, which I'll show you in a minute or so. When we look at also the year-over-year numbers, just to see how core numbers are performing, and also the year-over-year numbers for headline, we also see these numbers have moved up as well. So if we look at the year-over-year headline number, 8.2%, we see a trend here. Right? We see a trend that this year markets have, or inflation has peaked from 9.1% down to about 8.2. Now 8.2 is higher than the expected, but below the last month's 8.3. So you could argue for the last 3 months we've been seeing inflation come down in terms of the headline number because why? Because of oil prices, right? If you take a look at oil prices, let's see here. Oil prices have been dropping quite a bit, and that's why. So we see here oil prices have been dropping quite a bit, and that's why the headline numbers have been coming in softer. Now, of course, we had this move up, a 23% move up just recently because of Saudi Arabia OPEC Plus looking to cut production of oil, which has caused oil to move up, followed by a little bit of selling, and now pick back up again. Now, that's why the headline number came in. Continues to be lower when you compare the past data. Now here's something that's very interesting: the core number, right? Core number actually ended up at 6.6%, which basically beats the highest point of this year in April of 6.5%. So we made a new all-time high in core, which is telling you that inflation on the core end is not coming down. Now, the Federal Reserve of the US talked about the headline inflation being kind of this number that also trickles into the inflation expectation of consumers, and they want the headline number to come down, and they're focused on the headline number to come down because they want the expectations of consumers to start to believe that inflation is coming down. And if expectations start to come in lower, then that may help in terms of fighting inflation as well. However, I may have to disagree with that because, yes, you do see gasoline prices have come off quite a bit, but come off from its highs. We're still, we still have seen, we still see gasoline prices and crude oil move up all the way to record highs. If we scale back this crude oil chart, right? Um, Back in 2020 and onward. So this is still painful for consumers. Now, this has kind of alleviated some pain, but I would disagree with that a little bit because the core number is higher, and you see that when you look at the inflation report. You see that when you look at shelter, rent, and etc. And those prices continue to move up, which is creating again more pain for the consumer. So if consumers, may see gasoline prices lower, but their rent and their shelter prices and food prices are moving up higher, their essentials, their needs are moving up higher, then definitely, sentiment will still be relatively high in terms of expectations, in terms of inflation not backing down, right? So I don't think this number here, these numbers that's been dropping down, is going to change or influence consumers so much, especially if your shelter is still moving up higher. Or maybe it may balance it out. I don't know, right? But at the end of the day, this number is negative, and if you look at how the markets reacted to this, we take a look at. Let's just look at Nasdaq real quick, the futures market. We see on this day right here today at 8:30 a.m. we had a complete sell-off in Nasdaq and all the equity indices. Stocks went down, bonds went down, gold went down, dollar went up, all the currencies went down, and we sold off because of this high number. Now we completely reversed the move. We're now positive on the day, and the only reason why we're positive on the day, the only explanation that I could have, is because the sentiment in the equity markets are so weak. We've been selling off for so long, and we've also hit a very important support level here on the 38% fib level on Nasdaq. But sentiment is so weak. Sentiment is so weak that there are more bears than bulls. There are more people shorting than there are people going long. And when that happens, you can anticipate, or you can expect that, there can be squeezes in the markets. There's potential of squeezes that could come in, like we're seeing this. This is just a short covering rally, which is typical when there's more shorts than long. So I would more attribute this rally to a short covering rally, more of a squeeze. And just because everyone is short and everyone is so negative, nobody wants to, I guess, be long right now because inflation continues to move up. And since we've been selling off for days and days, you can expect a squeeze like we see here, which kind of kicks out all the shorts and pushes them out of the market, right, from the squeeze. So this is the only reason that I have that I could that I have when it comes to this rally after this sell-off, is just because the sentiment is just so negative that these squeezes can happen in the market. Now, when we look at the CPI index, right, coming from the BLS, just real quick here, I'll maybe post the link in the video as well. It says here that consumer price index for all urban consumers rose 4.4%. So we already seen this already. Increases in shelter, food, medical care indexes were the largest of the many contributors to monthly seasonally adjusted all items increase. These increases were partly offset by a 4.9% decline in gasoline. So, I've talked about this already. Shelter, food, medical care has increased, but it's been offsetted, right? The headline numbers offsetted by gasoline prices that has been dropping. Now the food index continues to increase, increasing to 0.8% over the month as food at home index rose 0.7%. So it's getting expensive to spend at groceries. It's getting expensive to eat out. Food is getting more expensive. And the energy index fell about 2.1%. So again, we know this, but natural gas and electricity indexes have increased because, of course, the issue in with Russia, Ukraine, with the war and all that. That's also keeping natural gas prices elevated. Electricity bills on in the Europe side, definitely you see a lot of that increases there. So as expected. The index for all items less food, energy. So this is now the core number that we're talking about, 0.6% in September as it did in August, right? So we see that the number here, the month over month number, 0.6%. And going back, the indexes for shelter, medical care, motor vehicle insurance, new vehicles, household furnishing and operations, and education were among the increase over the month. There were some indexes that declined in September, including those for used cars and trucks, apparel, and communication. So overall, we've seen that prices have moved up, and especially on the core end. Yes, gasoline has come down. You could take a look at this chart whenever you get time, but definitely, food has increased. They're elevated there. You do see energy services, fuel, gasoline lower, right? Shelter, big problem as well. So think about it, your rent, your shelter, your food is increasing. These are all essentials that you need when it comes to living, right? All of these essentials affecting you drastically, and you need these things, and they're becoming more expensive. I don't think that consumers are going to find this as if that inflation is getting better. Even if gasoline prices, may have a little bit of effect on sentiment, may be coming down as well, but who knows, we could see gasoline prices like we've just seen recently, that 23% increase after the OPEC Plus decision, right? That definitely, in the next CPI report, we're going to see higher, probably a higher report, a higher number, which will be very, very bad for sentiment, very bad for inflation, which means that the Fed can continue course, right, in terms of interest rates. Now, let's talk about interest rates just for a second here as well. So if we look here, the interest rate probability for November for the US is 100% priced in that they're going to get a 75 basis point rate hike, which is going to take the U.S. interest rates to around 3.7 to 4%. And there's a small percentage of 3% of a 100 basis point rate hike, but most likely it's probably not going to happen unless you get some sort of news that comes through Wall Street Journal, their news wires, saying that it is going to happen in terms of some sort of leak. But right now, we're priced in for 100% probability that we are going to get a 75 basis point rate hike. Now, what's very interesting is after this report, we also see, and this will change as we approach December as well, as we get new data, more information, another CPI report, some jobs data as well. But if you notice, we are priced in for definitely a 50 basis point rate hike in December, but notice that 57% probability of another 75 basis point rate hike. So pretty crazy that we're doing hardcore 75, 75, 75, and we're going, initially we started with thinking that, we would do a 50 in November and maybe, or 25 in December. But now we're talking about 75 in November and possibly even another 75 rather than a 50 in in December, right? So this is all adding to more of that pain. And remember, this data, inflation, is a lagging number. We see the effects of it later. And on top of that, the interest rate effects, we are seeing the effects now, which we started to hike rates in March. And we will see the effects of higher rates of 3% plus by next year. And of course, the effects of 4% and so on. And as we approach to 5%, we will see the impact of this as we move on and approach next year. So we're quite close. Definitely, you know, a very I would say kind of a dangerous report. Inflation's not backing off. The war is not backing off. Supply chain is not backing off. Some issues there, and definitely Fed can over tighten, over hike, push up yields higher, right? UK yields up, US yields up, and definitely doesn't look good for the stock market. And in terms of a recession that could come very soon. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, hit the bell icon to be notified, and let me know what you guys think about the CPI inflation. Do you think inflation is going to come off next year? Are we going to see it come off next month, or are things gonna worsen off? Are we gonna have a big break moment this year or next year? Leave a comment below, and if you have any thoughts on any topics you want me to discuss about, also feel free to throw that in as well. Anyways, good luck everyone, and I'll talk to you guys later. Bye.